YouTube family, what's up? What's happening? It's so good to see all of you. Thanks for joining me because I know it takes time out of your day to be here. You guys have been requesting videos on real estate taxation and how people save money with real estate when doing rental properties and things like that. Well, through all the comments, the pleading, the twisting of my arm, I'm crying uncle. I'm crying uncle. So this is the first ever video on real estate taxation on the channel.
Hell. It's about time.
Because I know there's a lot of investors out there who not only like investing in the stock market, but also like the idea of investing in real estate. And whether you're already a rental property manager, whether you already have rental properties or not, I think this video is really gonna help you, and it's gonna help you learn the rules, and we're gonna learn the rules one step at a time. Real estate taxation, just like a lot of other areas of tax, has a lot of different layers. There's layers of complexity. So I think the best way to digest this elephant and eat the elephant is one bite at a time, and that's exactly what we're gonna do today. Now, there's no question that real estate offers numerous tax advantages and can be a wonderful investment for you, absolutely wonderful. But if you're currently a landlord or thinking about becoming a landlord, one of the first things we need to teach you is how to not lose tax deductions. And there are several ways to lose tax deductions with real estate, and that's no bueno. No bueno. Now, I don't know for sure, I don't, but I'm guessing here that all the people across the internet, across the radio, across television, trying to sell you their fancy smancy course on real estate investments and getting rich quick and getting rich and passive income, blah, 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 blah. I am highly doubting that they're talking about the things I'm about to talk about in this video. I doubt it. You know why? Because limitations on tax deductions versus getting rich fast, it's not a good selling point. They want to sell you on get rich fast. I'm going to sell you on reality, and I'm going to teach you as a professional, because I've been a CPA now for over 8 years, or been doing accounting now for 8 years, of how this stuff works. When it comes to real estate taxation, one of the first areas I want to cover with you guys is limitations on deductions, because it's very important you know these up front, because if you're doing the wrong things and of how you manage your property may allow you to deduct the full, all of your expenses, or very little. So it's very important we know what the limitations are. So that's where I want to start here. As we're getting started here, if you want to support the channel and the work I do here, you can do so by dropping a like, leave a comment, and consider sharing this with others. Your engagements, guys, your interactions in the comment section is hugely important to me. And I read every single comment and I try to respond to as many people as possible. This is gonna help you learn more about the business of rental real estate, but being a good investor, I think it not only takes an understanding of how to manage a property or how to rent out properties and manage them successfully, but also knowing the tax impact and how to minimize your tax impact on the rental income you're making. It's just as important as knowing how to manage the property, in my opinion. This information is gonna help you accomplish that. So in today's video, we're gonna discuss one of the most basic and common limitations known as personal use day limitations. Personal use day limitations. Remember that. So many people run out and purchase a rental, and oftentimes it could be a vacation rental, someplace nice, near the ocean, near the forest, the mountains, whatever, right? Well, these same people, if they go and they think that they can use the property whenever they want, and still think they can deduct all the expenses on it. Well, they couldn't be more wrong. They could not be more wrong about that. Now, believe it or not, a rental property is more like running a business, right? There's a lot of things you need to keep track of, and taxes is one of them. Taxes for rental real estate involves a lot of tracking and record keeping, and one of the first things for you to get used to tracking is the number of days you use the property personally. So this is known as personal use days. That's where it gets its name from. It's those days that you're using the property personally. Now, if you're not using the property personally, and you're renting it out the property or have it up for rent at fair market value rents, those are known as not personal use days, but fair rent days, okay? So there's two concepts, personal use days and fair rent days. Gotta know both and what those mean.
Does personal use days mean that you just personally use the property for your own personal use?
Well, it does, Chipper, but there's actually more to it than that, as you're about to see. Personal use days has a broader definition than you might think. And so let's discuss that. A very, very common example of that is, let's say that somebody buys a vacation home near the beach. Most of the year they have it available for rent, right? But a few weeks of the year they live in the home and use it personally. Those days for them are known as personal use days. Now, important distinction is if you're not renting out the property, but you go to your beach home and you're just there to fix it up, you're not there to stay in it, but you're trying to improve it, you're trying to repair it, then even though you're in it and using it personally, it's not counted against you as a personal use day. Now, here's where a lot of people get hung up and get in trouble without even realizing it. So, let's say you have a home, whether it's near the beach or just you have an extra property in town, and you have a son or daughter, right? Well, and I, as a CPA, hear these stories all the time. Well, what do they do? What do the parents do? They want their kids to be able to live somewhere. Well, and they know cost of living now is ridiculously expensive. But mom and dad has an extra vacation rental, or they have an extra property that their kids can live in, right? So let's say their son goes and rents out the property from their parents. Well, and being a good parent, being a caring parent, they got mom and dad say, well, normally the rent for that property is $1,000 a month. But, Johnny, he's been a good boy, he's been a good son. Johnny, you only have to pay us $500 a month. That way you can help pay your student loans, you can help save for a home and whatever. So Johnny, you don't give us $1,000 a month, just give us $500 a month. So the question is that a fair rent day or a fair rental day, or is that counted as a personal use day? Well, as long as Johnny is in the home, renting that property for less than fair market value, those are all known as personal use days. And that's going to be accounted again, that's going to count against whatever deductions the parents have on that rental property. So even if you don't use it personally, but you let one of your friends or family members or whoever rent it from you at less than fair market value rents, that is known as personal use days.
Okay, Mike, I think I'm starting to understand this, but how much is it going to limit your deductions?
Well, depending on how many personal use days a person has versus fair rental days, your real estate deductions could either become fully deductible, partially deductible, or if you have too many personal use days, no longer deductible whatsoever. What do you mean by partially deductible? By partially deductible, I mean you must prorate the expenses between tax form Schedule E, which is the form for rental real estate, and Schedule A, which is personal itemized deductions, based on the number of personal use days versus fair rental days. Now, if that sounds confusing, don't worry, it is. But let me give you guys an example and hopefully it will clarify it a little bit. Let's say Chipper has a rental property, and out of the whole year, he uses the property personally 25% of the year, and the other 75% of the year, he legitimately rents out the property at fair market value rents, or it's fair rental days, right? Is Chipper going to be able to deduct all of the expenses on his rental property? The answer is no, he's not going to be able to do that. And why? Because Chipper used the property personally 25% of the year. Now, for personal use days, we don't need to know how Chipper used the property personally, just that he did in some way or another. He probably snuck away from his spouse so he could get some Fortnite game time in. And of course, by doing so, he really messed up his tax deductions. No! Okay, so let's say that on Chipper's property that is his rental, let's say the property taxes for his rental is $3,000 in total for the year. From a tax deduction standpoint, this is how this would look for property taxes. On Schedule E, Chipper can deduct up to 75% of the property taxes, which 75% of $3,000 is $2,250. However, since Chipper used the property personally for 25% of the year, then the other $750 of that, 25% of the $3,000, must be reported on Chipper's itemized deduction, Schedule A. Now, if Chipper can itemize, he's gonna get that deduction. But if he can't, well, he just loses it. That's just how it works. This type of allocation may apply to other rental expenses for this property as well, such as mortgage interest and utilities. And repairs and other such expenses may or may not be subject to these limitations, depending upon the circumstances. So as you guys can see from this example, knowing this first limitation for rental real estate is very important, because it's going to, the record keeping you're gonna do, it's imperative you do it, ladies and gentlemen, because if you want to maximize your tax deductions and avoid the IRS and audits, you want to make sure you're doing this right and have records to prove it. So it's imperative that you track your personal use days versus fair rental days on every property you own. Now, oftentimes, if you use a property manager, they're gonna track this for you, so you don't have to worry about it, but it's something you need to know about as a landlord or as a real estate professional.
Now, Mike, those rules are really helpful to know, but are there exceptions to these rules?
Good news is there are exceptions. The first exception is if there are more than 14 days of personal use and the home is rented for 14 days or less, no allocation is required. The home is treated entirely as personal use property. So if you rent out the home for less than 14 days and you use it for about 14 days, there's no allocation because the property is still 100% personal. Ouch, no tax deductions in that case, right? However, let's talk about the second exception. There is no personal use day limitation, no personal use day limitation at all, if you use the property for no more than the greater of 14 days or 10% of the number of days rented at fair market value rents. So let's say you use the property of 365 days. Let's say you use it personally for 14 days. But the rest of the year, you've rented it out, right? You've rented out that property, and that by doing so, guess what? Good news, no personal use day limitations apply to you at all. Now, when it comes to personal use day limitations, this is really the bulk of what you need to know. Now, knowing these rules is gonna help you better understand how to manage your properties from a landlord perspective and save you taxes at the same time. Now, I wanted to start the video here, this video series, with personal use day limitations, because most people, when they're thinking about real estate, all they hear in the media, all they hear being advertised to them in all these fancy real estate courses of get rich quick, is how much money they're gonna save in taxes by owning rental properties. It's not that simple. It's not. And their focus is to sell you a product. My job on this channel is to actually educate you on what the real rules are, so you can not only minimize your taxes, but be a better landlord at the same time and maximize your profits. Like I said earlier in the video, this stuff can be very complicated, and there's layers and layers of rules to understand when it comes to rental real estate and tax limitations. And if you guys, like I said, if you show a lot of support on this video, I'll keep cranking these things out so that when you do become a landlord someday, or if you're already a landlord, you know better of what to expect when it comes to taxes. If you like today's video, make sure you drop a like before you leave. Share this information with a friend who's either a landlord or somebody who's thinking about becoming a landlord. I greatly appreciate that. And if you're new to the channel, welcome. Be sure to subscribe, because on this channel, our goal and mission is to help you become fiscally fit as we teach finances, investing, taxes, and more on a regular basis. You can subscribe to the channel for free by hitting the red subscribe button and by hitting that little bell notification icon. It's gonna notify you every time I release new content on the channel. Have a great week, everybody. Thank you once again for spending time with me over YouTube. I can't wait to see you in the comments. Until next week, live life uncaged and take care. Peace.